Coming up on today's episode, the difference between investing for cash flow and then investing for that long-term wealth creation.
Yes. I think that is the modern way, so long-term capital growth is going to come, especially if the type of assets we like to buy are brick and tile, low maintenance property on a good block size, right? Those fundamentals don't change. We only buy established property in established location. Those fundamentals don't change. So I guess the modern way is we don't want to just wait for the capital growth to come in the long term.
Yeah.
We want to do our research, we want to do our analysis and identify areas where we can get short-term growth happening as well. Why? Because that short-term growth will give us equity, which will give us confidence to grow our portfolio.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Joe Agresta, and it's time to take control of your property journey together. Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Joe Agresta. Today, I'm joined by Arpit, founder of Buyerbud. Now, Buyerbud helps people find and secure positive cash flow properties with capital growth potential. And he works with buyers across strategy, property sourcing, due diligence, and securing the right property. In today's episode, we're unpacking something that is about to become a much bigger conversation for investors: positive cash flow property. With the recent budget announcement putting negative gearing back in the headlines, a lot of investors are starting to ask whether they should be buying properties that lose money each week and banking on future growth, or whether they need to start looking at strategies that can actually help a property hold itself. But positive cash flow is not magic, and it's not automatically safe. And if you chase rent without understanding the property, the tenant demand, the compliance, the lending and long-term plan, you can absolutely buy yourself a very expensive headache. So today we're going to break it down simply: what positive cash flow actually means, who it suits, what strategies people use, what can go wrong, and how investors can move forward without blindly chasing yield. So, Arpit, welcome to the show.
Thanks, Joy. Very excited. Looking forward to this. Yeah.
Me too. When we were chatting the other day, it was funny because you were on a video call with me.
Yes.
And you were at another project that you were building, and
Yeah.
I think it was co-living, that one.
Yeah.
And I've like I said to you, we need a whole other episode on that. But what excites me is, the budget announcement got released.
Yep.
And that has been the talk of the town now with investors who have done the negative gearing. So
Yep.
for those that aren't aware of negative gearing, it's basically making a loss on your property and saving on the tax benefit.
Yep.
That strategy has come under siege, and now people are asking, well, crap, how do I make this positive?
Correct. Yeah. I mean, historically speaking, a lot of investors are accidental investors. They get into property investment because their accountant says, oh, you're paying too much tax. You need to buy a property. You need to buy a negatively geared property, get some tax depreciation. So it was never a strategy for us. It was always icing on the cake. It was always like an added benefit that we get. The real reason why we invest in property is long-term capital growth. That is the reason why we invest in property, so we can build wealth through property.
Yeah.
Negative gearing, tax benefit, all of that. It's kind of always been and it will change. The thing is the government, whatever policy changes comes in, that can change again as well. But the real fundamentals of property investment is never going to change. Yeah.
No, 100%. And that's why I'm so excited to unpack it with you, because I think we're going to talk the house down in a good way today. So I think the best place to start, though, is, your background. For people who haven't come across you or Buyerbud before, can you tell us, a little bit about what you do through Buyerbud and the types of clients that you usually work with?
Absolutely. So at Buyerbud, we are a full-service buyers agency. We help our clients from the strategy, search to settlement and beyond as well. With the recent kind of, a few additional services that we started providing is also includes the conversion of a normal residential property into a co-living property, which is a Class 1B dwelling. We manage the conversions, the renovations, the operations, and in the ongoing, making sure we are maximizing the potential out of the property, and also, creating a really good environment for the the tenants who are basically renting, their rooms, but they're still sharing the common spaces. So it's really important to create an environment where people can really enjoy, and as the kind of term co-living. So you want to make sure you create a space where they really enjoy, sharing the space with each other as well. So it's really important, the management and the operation side of the things that, that get looked after as well. Yeah.
Well, because you have like a full service with Buyerbud, right? Which I like because it's a lot of hand holding and a lot of guidance. So that's what kind of drew me to, the business, but also I love the name of it, Buyerbud. It is like you're having a mate that's helping you buy.
Correct. Yeah. And that was always the vision behind it. Like that's how we chose the name, because we wanted to be the buddies. We wanted to be that, the helping hand, the guidance that can help the client, cut through the noise in terms of, because there's so many strategies out there. There's so many, conflicting opinions in terms of what you do.
Yeah.
And we genuinely work like that with our clients. Like our clients are like family and friends to us.
Which is great.
A lot of, so we're very boutique buyers agency. We work with limited clients at a given point of time. Our clients are mom and dad investors. They're not institutional investors or, overseas investors or anything like that. These are very much working class public. We occasionally do get, self-employed small businesses as well as doctors and, professionals as well. But majority of the clients are, people who've got like, IT workers, might be earning 150, 200, 300K every year. They're just basically trying to get ahead, and then we're here to help them out. Yeah.
No, that's amazing. And I think the other thing too is important. I think every buyer's advocate I speak to has always come from their own property investment journey. So, you built your own portfolio. Can you talk us through, I guess, how you first got into property and then how you got to where you are?
Absolutely. So very traditional approach, being an immigrant to the country. I came to Australia in 2008. I was under 18. So I did my graduation, got a job. My first job was McDonald's.
Nice.
Then started, got my IT degree, started working in corporate as well. And then, through that, I kind of was dabbling into like shares and crypto, and I lost money through it. And then I'm like, look, I want to do safe investments. So then property was the thing. And then, fortunately, we got a bit of equity out of the purchase that we did. We went down the established property route. So we got some equity out of it. And then we thought, okay, let's get educated. And 2022 is when I went really aggressive. So I bought 4 properties in the same financial year. And then I made about like $1 million equity in terms of growth. And then using that, I've now built 11 property portfolio, and they spread across 5 states across the country. So we want to basically diversify the investments. And now I do a lot of active stuff as well. So we, same thing, we do for clients as well. We do renovation flips, we do co-living properties. So we basically do a combination of cash flow with capital growth. So we don't want to ignore one for the other. So we want to get best of both worlds. That's how we create sustainable property portfolios without ignoring the cash flow side of the things, especially when you're growing a portfolio. And if you're going really aggressive, you want to make sure that you don't run out of cash flow.
I love that story so much. Like, you've wanted to invest, but you went really aggressive with it. Like 4 properties in a year is huge. Like,
it is. And to be honest, I know people, like we've got a client, we're buying their 6th property investment. They approached us for their first property. They grew their mindset. Obviously when the property grows in value, it gives you a lot of confidence as well. And if you've got the will, like if you've got the mindset, then there are ways you can, creatively structure your finance, get the lending, pay a bit of extra interest rate, if you need to, but, get that deal across the line, so you develop that mindset. Obviously, you don't do it with your first, second property investments, but, as you grow your portfolio, the game is very much addictive. So you want to continue on.
100%. And it does get addictive after that first property, especially when you see results. And you're like, okay, 3 more. And I guess what made you go from like building your own portfolio to then becoming an advocate?
Yeah, that's a very good question. So it's just organically happened. I was just helping a few family and friends, I was very open about my investments. I've never I've never been more into like hiding the facts or anything like that. I've just been very transparent in terms of, sharing where I've invested in and the reasons why. And that's how we do the client service as well. Like we're very big on the why. Like we want to make sure the clients are engaged and they're asking the questions why we're investing here and there. But like it's just really it comes down to like when let's say for example somebody approached me and then I told them, look, I invested in regional Queensland or Western Australia and this is what I was seeing in terms of the demand supply, and they really understand the reasons behind the logical kind of reasoning behind why to invest in a particular location or a particular type of property, and people really resonated with that. And then so I organically started helping like family and friends, and that's how so initially I was still working full time and then helping a few people on the side, and then it grew into something, and then I thought like I can do this professionally and full time. So then quit my job, and now we've helped more than 150 families.
Wow, 150 families. Congratulations. That's
Thanks.
huge. Thank you for sharing that. And before we go too far ahead, I have to actually do our no BS statement of the day. So if you're new here, this is the statement where we say something a little bit spicy, a little bit salacious, but at the end of the episode, we're going to have you decide whether it's bullshit or not bullshit after all the things we talk about today. So today's statement is positive cash flow does not automatically mean a positive outcome. So we won't answer that yet, but we'll come back and we'll see after the episode's done. What is it? So let's talk about the problem. The budget obviously was announced, negative gearing and the shift towards cash flow. With the budget changes putting, negative gearing back in the conversation, like what do you think has changed in the way investors are thinking about property?
I would say they're just more confused than ever. I'm seeing people, one side of, the crowd is not taking any action. They just like, people are just like, we're freezing because of like, the changes that are coming in. It's not only government policies, but it's also higher interest rate as well. I mean, the other half, I'm seeing people who want to buy, but the lending restrictions, the banks are getting tighter and tighter. There's the lending policies are also changing, which is making it harder to lend. So if anybody was sitting on a pre-approval, most likely that's not valid anymore because the banks have now, also shifted their criteria and then reassess. Yeah, really. So it's like, you've got, obviously owner occupiers are still very active, and that's what I think the government wants, as in more and more, home buyers coming into the market. So we're still seeing sort of, affordable segment, people who are buying in an owner occupier pocket. Like I was at an auction where I think there was more than 20 groups and, 6 active bidders. And, this is 80-90% owner occupier pocket that we are talking about. So I'm not seeing that much impact in those areas. But if you talk about sort of high end of the market, like $2, $3, $4, $5 million, yes, that is where you'll see a correction because it's just very much related to the interest rate,
I think that's the other thing too. Like the whole shift around the budget was encouraging investors to buy new, like doing the build and contribute to the stock problem that we have, instead of buying those established properties, that are negatively geared, typically. And I think this is where a lot of people are starting to get the phone calls, and why I wanted you on the podcast was because your strategy has been positive cash flow, and I always think, I don't know where this negative gearing kind of mentality came into play, how long ago, but wouldn't you prefer your investment is making money because it means you're earning? That's a good thing, even though you pay more tax.
No, absolutely. To be honest, like we've seen this shift ever since the interest rate started going up. A lot of people, and a lot of people have got different definition of what a positive cash flow means.
That's right.
Because it also depends on, how much deposit you're putting down. Do you have cash deposit or are you using equity? If you're using equity, in a way, that's loan as well. So for some people, it's like not even 100%, but 105% loan because you're paying for stamp duty and other expenses out of the equity as well, which is in turn a loan. But it's just one of those buzzwords, you keep hearing. And so positive cash flow is definitely one of them. But it, as you kind of said, we'll come back to it but definitely, it's not like one size fits all. Not everybody needs, positive cash flow. Also depends on, which stage of life you're in and where you are in your property journey. If you're early on in your journey, then definitely capital growth is way more important because you've got more time to build that capital. And then as you get closer to your retirement, once you're a bit older and when you get closer to the retirement, then you don't have that much time for capital growth. So then the focus kind of shifts from capital growth to cash flow. But yeah, as you said, the modern approach is like, going cash flow or not ignoring cash flow. I probably is the better terminology, as in going a bit more neutral. So not going too negative, but you can't ignore capital growth. I think that's very much important.
Oh, 100%, because that's going to be your access to either continue growing a portfolio or if you're buying just, for yourself and your family or retirement, like you said, it's going to impact that strategy in some way. So I guess when someone says, you made a good point, when someone says, I want a positively geared property, you said the definition changes according to what everyone means. Define it for us in your own perspective. Like, how do you define positive cash flow?
For me, I want to understand, the investor first. I want to understand where they're coming from and the reasons why they want to go for a particular type of strategy, right? Is it just because it sounds cool or their friends or family, went down that path? But it's really important to understand, because when you start kind of peeling the layers of the onion, you realize that, and then you can educate the investor as well. So it's really important to understand where somebody is. But yeah, in most cases, the misconceptions are really around that. Like, they don't understand where the actual money is coming from. Like, when you're buying an investment property, you need a bit of deposit, and you've got stamp duty and other expenses as well to take care of. So whether that's coming from a cash component, if it's cash, is it savings cash, or is it like, if they sold an asset, where is that money coming from? And then if it's equity, then they need to understand that it's also increasing their loan amount somewhere to pay for the next asset as well. So in most cases, with the current environment that we're in, because the interest rates are quite high, very few properties will be, actually positive cash flow. And even if they are, you're talking about a few $1,000s every year, which is not going to be life-changing for anyone. No. So it's the real thing is like, as long as your property that you're buying is going to give you capital growth and holding costs are minimal, or it's paying for itself, meaning that it's not costing you anything to hold that particular property, then that's, to be honest, in this current day and age, those are really good asset types to be buying. Yeah,
I think that's well answered too, because there's so much involved when you make an investment. And positive cash flow, I think by definition for a lot of people is, I earn money, so I have surplus, so I don't need holding costs, I don't need to pay maintenance. But in reality, if you bought a property at, let's say, $420,000, you've still got like maybe $450, $500 a month in just holding.
Easily. Yep, absolutely. So you've got like insurances, council rights, maintenance, the list goes on.
So, and I think that's where people are underprepared for that idea. So like you said, with cash flow being a key component here, focusing on, okay, that's fine, but how's the cash flow of that situation? Do all your bills come in the last week for that property? And you're paying, $1,000 in one go? Or are you paying that across the month where it's $200 a week?
Each property investment, I think, works as a business, so you put a bit of capital in and you still need to keep an eye on your cash flow. Investors who are able to hold on to their portfolio for longer are the ones who can, really navigate through the interest rates going up and down, because they've got cash flow surplus, or, the rents are going up. You want to be buying those type of assets where it makes it easier for you to hold on to the property, so that you don't have to panic sell, when the market gets a bit tough.
Correct. Because when the market gets tough, that's the scary part for a lot of investors is if they haven't got their buffers or a good accountant there or a buyer's advocate to tell them how to manage that asset. That's where things get scary.
Absolutely.
And you have to panic sell and make a loss, which is terrible.
And that's why I like that. I like the idea of diversifying, because maybe 2, 3, 4 years ago, we're buying a lot of properties in Queensland and Western Australia, but now we're not buying there because those areas have grown too much. Now, if somebody was, let's say, aggressively investing in Melbourne in the last sort of 4 or 5 years, now they're stuck because they haven't seen much capital growth, and then the cash flow has been negative. So, it just makes it really hard. But if you were diversifying your investment, then at least at some point of time, your overall portfolio is moving because you've got some equity coming.
I think that's what people don't get about the multiple investment angle, right? And that diversification. If you have, let's say, a co-living arrangement, so that's an asset type, and we're going to get into this properly, but you're getting multiple rents.
Correct.
Now, you've got like this whole pool of money to come in, but then you've got a property on the left that's a standard house, negatively geared. You can shift some of that funding over there to balance it out so they're both surviving. And that's why that diversification matters. If you have a portfolio of all negatively geared properties, that can be really tough
Really
unless
difficult.
you're in a very good cash position.
Correct. And look, it's okay for people who've got a really good active source of income. So if they've got a business which is generating really good amount of cash flow, for them, they can do land banking. They can buy assets which are negatively geared because they can, use the cash flow from their business to hold the assets. But for majority of the working class people, like again, if the inflation goes up, their expenses goes up. They've got kids and other expenses. So it adds up. That means they just don't even think about investing. And this is the type of people that we help, every day. We want to make sure that they don't get stuck, that they're able to continue to build their property portfolio.
100%. And I guess it brings me to an important question about in your opinion, who do you think the budget announcement and everything, who has it affected the most? Is it the first time investors, the rent investors, or maybe existing ones, or people with limited cash buffers?
Yeah, I think it's more to do with first-time investors. So it's people who were trying to, just waiting on the sidelines. They've seen COVID booms and, they've seen their friends and family kind of build a property portfolio. They were just about to get started. I think this will just scare them off because this is another reason for people to just fear not getting into the market and for some people who are just always a bit negative in terms of I'll wait when the market crash, 10, 20%, then I'll enter, which to be honest, nobody can time the market perfectly. There'll always be right now, it's a great time if you can get your finance sorted and if you can buy something. There's plenty of good deals around to be picking up, but it's just it's just mindset will be real big thing. For a lot of people, they just worry about what's happening in the media rather than how they can control their own lives.
It's such an important point. I say this all the time. The media is noise. Some of it's true, some of it's false. You don't know, but always talk to professionals to just assess your situation because just because the media said, oh, this is very bad for existing investors, call your accountant. If you're an investor that, like you said, the ones that are most affected are probably the ones that had the intention to buy.
Correct.
Now they're scared. This is the time to talk to those accountants you have, talk to the mortgage broker, talk to an advocate even, to say, what options do I have now that my plan was to buy established and negatively gear it? What should I do now? That's what's going to help overcome that fear and that mindset of, oh, this is a bad idea, I'm not going to do it. Because it doesn't mean that all hope is lost.
Yeah, exactly. No, I think it's just that, the media creates fear, I think it's a lot of that fear mongering where, our market has crashed by 20%, but where, you're talking about median prices of a market, which is $4 million, $5 million. Of course, you'll see, difference because there's not that many properties, but if you talk about the affordable market, 10-20% is a lot, in property market. Generally, you wouldn't see that kind of a correction. Also because you have to look at macro level. Australia's construction has really slowed down. Demand is still there. There's still more and more people kind of, moving into the country who would need housing. Basic necessity.
That's why they've made the budget announcement to shift you into building.
Yeah, but that's the other thing, right? New builds, it sounds good and some people get really attracted by the depreciation benefits or the fact that will be low maintenance, which is all big myths because new builds can have a lot of maintenance, lots of issues, a lot of builders getting bust. Costs have gone up significantly. So if somebody is just changing their strategy just because of the government policy, they'll just be paying top dollars to the developers and builders and then buying something in a greenfield area which doesn't grow in value. Not a great outcome.
No, not at all. And I think that's the concern for a lot of these, new investors too. It's typically buying a new house is like buying a new car, right? You lose value the minute you drive out of the driveway. And you've got to hold it for a long time to start to see the return. I built my first home with my partner. We've been there 4 years, but we bought in a good location where we've seen a significant increase in our capital gains. And the equity in the house is quite good, so we've got options now. But had I not have purchased, I guess, in the right location, a lot of this affordable housing stuff is being pushed into really, distant locations where they're not built yet.
Yeah, so I mean, it takes time,
Yeah.
right? So like, and in certain areas, again, like new builds is not bad as long as you can buy something in a little bit more established area, or where there's not going to be like thousands and thousands of similar type of properties like yours coming up. Because then, from an investment perspective, it makes it harder to rent as well, because the vacancy rate is going to be really high for those areas.
Correct.
So yeah, if the rents are not going up, plus if you're ever trying to sell your property, you're competing with like 50 other properties. It creates like that apartment type of an effect, which is the biggest issue with homeland packages in a cookie cutter kind of location.
It's so true, because you end up with the same house as the person next to you.
Correct.
Depending on the builder. Like it's so hard, and to diversify, like you said, as well. And I think the other part too is like, let's say someone listening is like, no, positive cash flow. Like, before we even get into the topic, like, who should be careful before chasing positive cash flow? Like, is there an archetype or a person that you think don't run too far?
I think understand the underlying reasons behind why somebody would want to go down the positive cash flow path. I think that's really super important. Like understanding, the real kind of reason, the goal, the strategy behind it. And if you are at that stage of your life where, look, you want to get a bit of more passive income and you want to get higher passive income, that is where positive cash flow makes sense. Or if you've got, another income, and if you want to be like, the asset that you're buying, if it's going to help you, as you mentioned, if you've got a few negative geared properties and you're buying a new positive cash flow property, so you can pay off, the negative gearing part of that. So you just balance your portfolio out like that. So in those cases, yes, absolutely. It would make sense for somebody to add a positive cash flow. But if you're buying your first property as your positive cash flow property, just purely for the fact that it's positive cash flow, I don't think it's a great strategy, because, and again, it's not like we are trading off capital growth for positive cash flow. Like we've got strategies where we can get both, and but again, it comes with a certain level of capital. It comes with a certain level of risk as well. And generally, this is for somebody who's more mature and investor, somebody who's kind of got that level of risk appetite as well. Because generally, with higher yields comes with higher risk as well.
Correct. And it's all about that risk appetite too. Like, you got to weigh up the pros and cons and talk to, someone like yourself or an accountant to say, what's a good idea for me? And I think ultimately that's what ends up dictating your strategy anyway, because you might have very little pay, but you've got a heap of equity in your PPOR.
Correct.
So you could use it, but you can't sustain it from your job status. You need another job, or you need to increase your pay somehow.
Yes. Yeah, that's a good point. And as you mentioned, you need a really solid team around you. If you, really want to grow your own portfolio, then you want to work with people who are investors themselves, be it accountant, mortgage brokers, buyer agents, good conveyancers, property managers, the list goes on,
so important.
Yeah, absolutely. Yeah. You got to have that network around you who can bring you up. Yeah.
Because they're like, everyone works together. I think that's what a lot of people misunderstand, especially for our first time investors listening. Like, the team around you really is a make or break for whatever your strategy is. And those professionals need to work together too.
Yes.
So it's not like you hire a buyer's agent and you're the go-between. Usually the buyer's agent is the hub of keeping everyone together, because you're the one chasing the asset.
Yes.
But they're working with your accountant, they're working with your broker, they're working with property managers. They're trying to make this a one and done solution for you. So it has to work for everyone.
Absolutely.
Especially you. So I think, I like to go into options, right? Because, there's a very important thing you said at the start, which was mindset. And I think there's like a specific mindset you have to have before you start in this investment journey.
Yeah.
So, I guess before someone even picks a strategy, what mindset should they have?
I think the mindset that you wanna get ahead, that you just don't look. Nobody's gonna come to you and offer you the amazing deal and passive income that you don't need to go to work, 10 years from now, 15 years. You have to start working for it, right? Yeah. So it's keeping that goals in your mind, and, to work for it. Like a lot of people, I feel like also, put it on a too hard basket, or put it on the back burner in terms of that, property investment, I'll do it after my holidays, or, I'll kind of do it next year once it's a bit easier. I'll let the dust settle. And, you hear these type of things quite often. But it's the mindset of like, I want to take action right now, that I don't want to delay it any further if my finances are allowing me to do it, or if not, I'm going to talk to a few different brokers and see if there is an option out there. So you got to put in that work. Initial work or initial will has to come from individuals. So like, in this case, we're talking about clients. So in our case as well, like they need to have that level of motivation when they come approach us, or any professionals for that matter. And then the rest, there are ways to problem solve, right? Like, if somebody's got a specific situation about their finance, for example, then there may be lenders out there who might be willing to give loan. But then again, it comes at a cost. 0.5, 1% extra interest rate. Do you have the mindset to pay that interest rate?
Yeah.
Well, is the property going to grow more in value? Absolutely, 100%. So then do you take that risk? Yeah. So obviously everything comes with an element of risk. But once you take that, I think that's where, that's where, I keep going about, like, the first time investors are the most affected by the budget, because it's like taking that first step is always going to be the hardest, Doesn't matter whether you're starting out, like, you're going for a new career, new job, new business, or buying your first investment property. It is nerve wracking, it is hard. But when you go through that and if you see results, then you keep on going. Yeah.
You do. I think it's very rare when you meet someone who's bought one investment.
Yeah. And they're like, I'm not going to buy.
Yeah. They're like, oh, no, that's it. I'm done. Yeah. It always ends up with a portfolio.
Yeah, exactly.
And this is how people kind of like, they take that first risk, but I always say it's not taking risk for the sake of it. You're taking a measured, calculated risk. Absolutely. It's like, okay, I can cope with, you know, I had a broker on just earlier today, and she mentioned, like, even if you get pre-approved, right, for a certain amount, the bank assesses you at 3% higher than whatever the rate is.
So the buffers are in place, So yeah.
Correct.
And obviously, everybody needs to know their own kind of, personal situation, their lifestyle. And no, we're never going to say that, let it impact your lifestyle or, over leverage yourself. No, you don't need to,
Yeah.
Because I think that's where I think we're blessed, in a country like Australia. It's not that hard to get a loan, especially when it comes to housing, such a big sort of a market where there's heaps and heaps of lender. And I think this is the most safest, like mode of investment. Like if you want to invest into something, property is the way to go. Yeah,
I agree with you, because it's stable long term, provided you buy the right thing and don't overstretch. It's blue chip. Yeah, exactly. And I guess, too, like, what's the difference, I guess, between, like, you touched on this before, but the difference between investing for cash flow and then investing for that long-term wealth creation?
Yes. I think that is the modern way, so like, long-term capital growth is going to come, especially if the type of assets we like to buy are brick and tile, low maintenance property on a good block size, right? Those fundamentals don't change. Mm-hmm. We only buy established property in established location. Those fundamentals don't change. So I guess the modern way is we don't want to just wait for the capital growth to come in the long term.
Yeah.
We want to do our research. We want to do our analysis and identify areas where we can get short-term growth happening as well. Mm-hmm. Why? Because that short-term growth will give us equity, which will give us confidence to grow our portfolio. So long-term growth, it will come. Like if you invest in property which has got a land component, it's a proven fact that freestanding homes will give you that long-term capital growth. But the areas that we want to be targeting, and this is where we are not, fixated on a particular type of, location or property. We can buy properties all over Australia, but we want to be targeting areas where the demand is more of a pressure cooker effect happening tighter supply. Those are the kind of areas that we want to buy. Yeah.
Well, this brings me to like the crux of today's topic, right?
Yep.
Because now I want to talk about the options available. So it's like, in terms of these positive cash flow structures, what's there? So I guess, what are the main ways investors can try to create stronger cash flow from property? So there's like, obviously like a standard investment property, there's new build investing, renovations or value add, short-term rental or Airbnbs, co-living. Of those options, which strategies are the most misunderstood?
I guess all of them are misunderstood, even like throw commercial asset into the mix as well, But if you talk about just residential asset, like there's a few different ways to get the cash flow, right? A lot of people have this misconception as well that, regional property investment, who would want to rent there and would they even be able to afford rent. And, I showed them examples where like, a 650K property in Melbourne would give you 450, 500, 550 rent, whereas in same property in regional area might give you 650 per week rent, So this is the point of difference where, that additional $100 rent means that what you were $5,000 negative on that particular property in metro areas, you won't be that. And then, people have this, again, misconception or myth, whatever you want to call it, that regional areas don't grow in value or who's going to live there. I've shown them tenants application earning like 300K per year, but still they're renting. Well, that's their lifestyle choice because they have gone there for a project or, temporary or, who knows? Everybody's got different situation. But the thing is the vacancy rate is 0.5%. There's no property available. Affordability is quite high. People incomes are great, So yeah, there's a few different ways, you can get that, higher cash flow happening. So regional investing is one of them.
Yeah.
Another one is, again, depends on like how much risk you want to take. But like, for example, we don't go and invest in mining towns. But if I was buying my 8th, 9th, 10th property, I wouldn't mind taking back. I've got a commercial property in a mining town, which is giving me like 10.5% yield. So it's purely a yield play. Like I'm not expecting capital growth out of it. But if I was doing an investment for somebody who's buying their first or second property, no, it's never going to be those type of areas. It's going to be more either metro areas or regional cities, which are got diversified economies, bigger population and things like that. And then you've got other strategies. Obviously, we do renovation play is very good at the moment. Value add strategies are really good, but again, you need to have additional capital available, or either in a form of an equity or cash to be able to inject into the property. But if you can do that, that means you're doing two things. You're saving on stamp duty because the purchase price is lower. And generally speaking, the type of asset that we would go for is where we can make, our money work harder. Let's say, for example, if you're going to put $1 into the renovation, we want to get $3 or even $2 back in terms of equity straight away. Like we're talking about instant equity. And then, obviously you've got Airbnb, co-living as well. In both those cases, you need to put in capital in terms of furnishing the property, permits, council permits, health inspection, all of that stuff. With co-living, there's even more because you need to get planning permit and building permit for converting a normal residential property into a class 1B dwelling, which is a strategy that we are really liking at the moment. Like that's what we are going for in Melbourne quite aggressively at the moment. If somebody's got capital up to like $1 million or 1.1, something like that, and they want to get into like a really, blue chip location, where they're paying majority for the land value, and then we get a big house, let's say 4-bed, 2-bath, standard dwelling, which in a normal traditional renting environment would rent for $650 per week. By converting into co-living, we can make about $2,200 or $2,500 rent out of it.
All right. Thanks for explaining those options, because I think there's a lot of people that hear those. Like opportunities, and they don't really get it. And this brings me to the one I want to unpack properly, because co-living has been such a buzzword for the last couple of years, where people think they understand it, or maybe they see it as a scam or some sort of pyramid scheme, which I can assure you it's not. It's a strategy. I want to unpack it with you. So I want to take an example. So let's say that the purchase price for the property is $650,000. The rental setup is one household. So at the moment you've purchased it to rent one family in there. The rent is $650 per week, and it's one income stream. Now let's put the co-living example on this same scenario. The purchase price is still $650,000 for the property. So you've bought a standard residential home. You've set up the rental setup with 5 separate rooms. So let's say you have to inject, maybe $100,000 extra. What would you say?
Depending upon how old is the property, how many bathrooms you've got and things like that. Like, if you're generally not creating new bathrooms, it's not very expensive because you're just putting a bunch of stud walls and, painting. The real cost is really the planning and permit, which, so I think, I guess even 50K can do it sometimes.
Right.
Like there was one renovation we did recently. I think it costed about 60 grand to do it all.
Right. So then let's take that measure, 50 grand. So like you've purchased at 650 for the house. You've added 50,000 on top for, conversion. And then instead what you've done is you've got 5 separate rooms now in this home, 2 common areas.
Correct.
And your rent per room
Yep.
is $300 per week, which means you're earning $1,500 per week, and it's a five streams of income coming in. So in the traditional example, one tenant or household pays one rent. In the co-living example, the investor is trying to create multiple income streams from the same property.
Yep.
And they've spent the same amount of money, maybe $50K more. On paper, that sounds unbelievable. Why wouldn't you do it? But this is where we need, the no BS part from you, because more rent does not automatically mean much like better investment.
It's like more headaches sometimes. Yeah.
Exactly. So can you explain co-living in the simplest way possible and what investors need to check before they even consider this strategy?
Yeah. So I think, again, the fundamentals, like the demand supply doesn't change. So you need to make sure that this property, the location, is it close to train station, hospital, retail, shopping center? Like who's the type of demographics that you are targeting? Is there even demand for the room by room rentals? Yeah, you can't just do it anywhere. So location is first. Then comes the floor plan. Is the floor plan supporting co-living as well? Because you need a common area and you need to create a bunch of bedrooms, right? Now we are talking about purely conversion. So we're talking about converting a standard residential property into a rooming house. But then you've also got concept of purpose-built rooming house, right? Like, which is co-living property as it's called. That one is a lot more expensive because, again, construction costs have gone up. A minimum you're going to try and build in Victoria, you can do up to 9 bedrooms. But in some cases, even if you go like 5 bedrooms, generally, when you're building new ones, you want to try and create self-contained, as in each room will have their own ensuite, a small kitchenette. So it's like, self-sustainable, as in like, self-contained. Or in most cases, these are people who are either working class professionals, students. There's a lot of different reasons, like doctors, nurses, whoever, who might be living by themselves because of a certain job situation, or some people are separating. That could be one of the reasons why they may choose to go down this path. But they don't have that much interaction with the other tenants in the property. So it's very important that their space, like their room, it's like furnished. For example, we normally try to put like a bed, a TV, desk, chair, those type of things, just so that they can kind of spend that time in the room. And then really it's the kitchen area. Then you need to have pantry storage, fridge space, all of that stuff needs to be counted for. Obviously you need, bins, which is like, because you're going to have so many kind of, tenants living in the property. You need to have more bins in the property. You need to have, laundry areas, or in some cases, commercial laundry as well. So, those type of things you need to consider. But coming back to the numbers, in a metro area, like 650K property is probably a bit hard to get, especially if you're going to be, because this strategy will only work in a more established kind of areas. And our strategy is simple. Like, we want to spend the value, or majority of the value needs to go towards the land component. So anywhere in Metro Melbourne, if you're going to target, let's say, a 500 square meter block, the land value itself is 500K, right? Roughly speaking. So then, getting 650K asset, it's a little bit hard, but not impossible. But let's say, for example, let's just stick to, your example, let's say regional location. But again, certain bigger regional towns, yes, it's actually, we're seeing a lot more popularity. Like you go down Latrobe Valley, Ballarat, Bendigo. Yes, we're seeing a lot of these co-living properties happening. Shepparton as well. And again, it's just demand because they've got hospital, they've got university, they've got train station, they've got people moving, for convenience. Correct. So let's say it's a standard 4-bedroom, 2-bath. It's got a couple of additional living areas. If there is a laundry, you can convert that into an additional, wet area. Yeah. So like put in a shower or toilet. Highly desirable. So you want to have a good amount of ratio of bedroom to bathroom. If it's 1:1, amazing. But the next best is 2:1. And I would, maximum we would do one is like 3:1. You don't want to do anything more than, 3 bedrooms sharing 1 bathroom. So it's those type of aspects you need to kind of really think about. So, what does the property have? Does the property have ability to put in more wet areas? And the bedroom size. There's also, light, like how much light you're getting into the bedroom. You don't want it to be super dark and things like that. Also, there's some regulations in terms of that you need to follow in terms of the size of the dwelling and other things as well. But yeah, generally speaking, if you do it right, like regional areas, you're looking at about, if it's just a room with not an ensuite, you're looking at about 200 to 250 per week. In metro areas, like 250 plus. But if it's got an ensuite, then then you're talking $300 plus. Yeah,
right. Like, I think this is the big thing. Like, thank you so much for explaining that, because I see now why you've grouped it into Airbnb, because with Airbnb, like, it's all about the target demographic. It's like you can have an Airbnb, but,
location,
and what you're buying for and who you're, building for makes a difference. So I see the same thing here. Like you said, you can't kind of plonk this
anywhere
and say it'll do really well. It's got the location matters and who you're building it for.
Absolutely.
Because, like, I'd imagine, your metro areas, this would be great for students going to university far out. If you can get a property without spending an arm and a leg, you'll get some good student accommodation out of it.
Exactly, yeah.
But if you wanted to go to your regional towns too, for the people that are passing through, like, or trades that are on those, stints where they have to work for 6-12 months on a job site in the region, this is a really good, demographic to build for.
Yeah. Now we're seeing that quite a lot, actually. In fact, there's some hospitals and even some, like railroads. Like I've kind of, been asked from certain regional towns, like they're actually looking for such accommodations because, they don't want to, get a motel, for these workers, and they want a functional space, and if it's managed well, then people are actually like it's a highly desirable kind of accommodation. Yeah,
especially for like a company to be able to rent that whole place out for 12 months for a project. I see the mass appeal in that, because it's more cost effective for them too than Airbnb rates every night. And this brings me to one of our best segments that our listeners always write to us with. It's our Reddit Real Talk. This is where we take a real world scenario or property question, and we have you, the guest, unpack it with us. So today someone submitted a story. I'll read it out and then I want to get your thoughts on it.
Yeah.
So today's story is, maybe I'm just overthinking this, but I'm genuinely struggling to understand how people are still investing in property right now. Feels like all the old advice was based around negative gearing, CGT discounts, tax benefits, etc. And now with all the changes with the budget, rates being high and everything expensive as hell, I can't tell if the numbers even work anymore. I've been trying to look at places and half the time it just feels like I'd be losing money every month and praying prices keep going up. Lol. Are people still buying investment properties right now? If yes, what kind of stuff are you even targeting now? Houses, units, regional, interstate, positive cash flow stuff? That's their question, right? So I guess if someone came to you with this exact concern, and this makes so much sense why you said the most impacted are going to be
it's going to be that, that someone who is basically was thinking about trying to get in, has started doing their research, and I've come across all these different strategies out there, different types of assets. And clearly they're overthinking this because I guess, the most important thing in all of this is like taking action, and the ability to take action, before even taking action. Of course, it's always a great time to be buying properties. You are making wealth when you're holding assets, when you're buying assets, not when you're, selling. So it's like, definitely. I think it's just, bringing a bit more clarity. I think education, like doing the research is one thing, but having clarity of thoughts in terms of, what does my budget allows, I think start with your finance, always start with your finance, understand where you stand in terms of your savings, your surplus, like, how much surplus do you have to be investing into something? What is your borrowing capacity? How much banks can lend you? Do you have, parents who can support you, for your first one? Or do you have savings, to get in? Do you have any government schemes that you can get into? Again, not a bad thing, like whatever helps, get into your first property. But I guess like the modern way, and it's not like you don't need to sacrifice cash flow for capital growth. Like yes, the traditional investing, and still like a lot of people go to their accountants for investing advice, which is not probably the best place to be because And again, some people go to their mortgage brokers for this advice, and they, probably are not the best person as well when it comes to providing like the type of investment advice. So you need to go to the right professional to ask the right type of questions. And I would not know which bank is, has got what lending policy. Like, so everybody has their own lane. So you need to, and again, it can get a bit confusing. Like I can completely understand if I see myself, when I bought my first property back in 2018, again, we were ready, like my wife and I, we were ready with deposits, 5% deposit. I think 2015 we were ready, but we took 3 years to save up 20% deposit. And that was something that we were told, that you need 20% deposit to buy a first property. You don't want to go 10% and you don't want to pay LMI. And that was the advice that we were given. But had we bought something, we would have gotten into, better suburb. We would have had more equity in our property. So it's like starting sooner is definitely
the right play.
Yeah, but that's just So that's, I guess, it's really, and these are typical, clients that we used to work with, and we still work with, them. But yeah, it's like developing your trust, in a professional is also really important as well. That because then if you trust their advice, then you take action, and then if you see the results, then it gets a lot easier.
It does, and that's why people come back for second, third, fourth, fifth,
like
properties.
We've got clients who are buying a third, fourth, fifth, like sixth investment as well.
Which is amazing. It speaks volumes. It's just that first one to get your foot in the door. And I guess, what's your advice to the investors? Like, what should they do next? If this was an investor that you came across who is trying to struggle with this, what do they do next?
I guess just start, as I said, start understanding your finance and what you're comfortable with. Obviously, do some stress testing as well in terms of, let's say, if you're saving, let's say $3,000 every month, let's say 2,500 to 3,000, whatever. Is there an investment property out there where I'm only negative by $1,000, go conservative in your numbers. So to see, even if there was a couple of more rate rises, can I hold this property, So just do very practical, situation. Exactly. It's all maths. And then take that action, and then once you take that action and if you see the results, then you go for the second one. And that's how it really starts. But not taking action is never, the best move. And as I said, nobody's going to knock on your door and say, oh, here is the best deal you can get investment property. I've sorted out your finance. And,
thank you.
All you have to do is just sign this contract. It doesn't work like that. You have to, take action. You have to speak to professionals. You have to do the work. You do the work. And then, people are, obviously businesses do exist like us who can help them as well. But the first step needs to come from them.
I love it. Great advice too. It's that foot in the door. I think, you just got to start.
Correct.
And that starts with conversations, which I always say, it doesn't cost anything to have the phone call.
Yes, absolutely.
Pick up the phone and just ask the question, like, how do I do this?
I think a lot of, the brains get clouded because of AI as well. Because a lot of people started asking, Chat GPT and Claude and other things. And I've got a few clients like that as well who just get so confused because every advice they get, they try and run it past, the AI tools. And then generally the answers you get back is what you would tell yourself, it's like
very affirming.
It's telling you what, you want to hear, right? So it's never it's never going to be like a conflicting advice or something like that. It's never going to be very direct. So I think that's another issue as well right now because
I got to tell you, I did an example because I was thinking about this going, okay, I'm going to put in ChatGPT. I'm like, I've got a property that I want to buy. It costs $500,000 and, it's a house with 2-bed, 1 bath, regional Vic. Also, the vacancy rate is at 2.5% and the rental yield is sitting at 2%. Do you think I can make this into a positive cash flow investment or do you think I should invest here? Told me yes. And I just said, my God, it's like, oh, this is actually an interesting opportunity for you. I see why you like it. And I'm like, nah.
I had a client, we were looking into New South Wales market and she was like, okay, what are your top 3 regions in New South Wales? I was like, based on your own situation, these are the 3 regions. I was like, oh my God, Claude said the exact same thing. I was like, now stop asking Claude. Now you've made, you've done the test. Now, so it's going to be obviously, it's true to a certain extent, but it's like what you're putting into it in terms of your prompts.
It's hard to know whether it's truly advising you properly or if it's not. And
exactly.
and this is going to be the battle.
Yeah.
Well, but I can't believe how quickly this has gone, to be honest with you. I have to come back to our statement of the day. So before we wrap up, the statement was, or the no BS statement was, positive cash flow does not automatically mean a positive outcome. All right, Arpit, final verdict. Is that bullshit or not bullshit?
No, I think it's not bullshit.
Yeah.
It doesn't always mean a positive outcome, because positive outcome, as I said, I would always rate. And again, it depends on who I work with. Like I work with a lot of, as I said, families, mom and dad investors. For them, the positive outcome would be long-term capital growth, something that they can, use for their own retirement and also pass it on to the next generation. So building that intergenerational wealth is what and why we do this, So for that one, you don't need to chase positive cash flow on day one. But yeah, understanding your finances is really important. So yeah, understand how much negative you can go. And as long as you're not going too negative and you can hold on to the property for longer, focus on capital growth early on. But if you are a more mature investor and if you've got a few assets and now you're starting to think about positive cash flows, it's perfectly fine. I think you should be thinking about cash flow because you want to hold on to your existing portfolio rather than selling and buying, because the transactional cost can be so high in Australia. Like every time there's capital gains tax, every time you have to pay stamp duty, selling agent cost, buyer agent cost. So it's really important that people keep that mindset that they want to build a property portfolio and not like flip properties. It's okay to flip properties again, once you have a bit of a portfolio, and then do that. Yeah.
I love it. And that's a great way to, leave this episode. Good advice and good guidance. Thank you, Arpit, so much for sharing your wisdom.
Yeah.
Of course. And, I think the big takeaway from today is that positive cash flow can be a powerful strategy, but it's not a magic shield. So be careful with it. I think a property making money each week is only useful if the asset, the location, the numbers and everything is making sense. So with the budget changes putting more pressure on investors to think differently, I think it's more important than ever right now to understand what you're buying, talk to the right professionals, as we've been saying this whole episode. There's a lot to be done there. So as always, thank you to Arpit and thank you to our listeners for tuning in every single week. We appreciate your support. And if you want to get in touch with Arpit, his details are on screen and in the show notes below. So I said it before, it costs nothing to have a chat. So I'm sure Arpit's not going to say no to you.
I'd love to have any, we do a lot of discovery calls, and these are not short discovery calls. These are very detailed, deep dive sessions where we truly understand, where you are in your property journey and see how we can assist you. Yeah.
I love that. And thank you so much for sharing. And thank you everyone for listening. As always, this is Jo Agresta this is the No BS podcast on Spotify. We'll see you next time. Bye for now. That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodi AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodi.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodi AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodi.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.